Alright, now regardless of which depreciation method you use, in all three of those scenarios we depreciated $22,000 worth. So it doesn't matter which method you use, it's all about timing. For example, if you use the straight line method, you're going to have exactly the same amount of depreciation in every year. But if you look back to our previous example with the double declining balance method, you put most of the depreciation in the early years and less depreciation as the years went on. Alright? Meaning you got to show more expenses in the first year because of that depreciation expense and way less as the years went along. And you might want to go with this method if you want to show, if you want to pay less taxes. So you want it in the early years of a business, so you'd have more expenses in the early years of the business. All right, and units of production, as you know, goes up and down depending on how much you're actually using the item. All right. Just wanted to mention that the IRS uses almost the same thing we just did, the double declining balance method. That's pretty much the depreciation method that they use, and it's called MACRS, which is the Modified Accelerated Cost Recovery System. And I just wanted to indicate that it is basically the same as double declining balance. There's just a few things that they use, something called a mid-quarter convention and mid-year convention, that are slightly different on timing, but ultimately the calculation is pretty much the same. All right. Now, here's one question. What happens when you change your mind about how long an asset's going to be good for? Now, you're putting this asset into service, and you have no idea, really. You're the accountant sitting up there at your desk, and somebody says, this good asset's going to be good for about 5 years. And so you start depreciating it based on 5 years, and you say, well, is it going to have a value at the end of 5 years? And somebody says, about $10,000. You go, okay, great, and you're able to do your calculation. But what happens if you're going along happily with your depreciation and you find out later that asset's going to be good for a lot longer than 5 years and the residual value is going to change as well? So when we're changing these estimates, we have a little bit of work that we have to do. So here we are. Let's revise this estimate. Machine purchased for $140,000 was originally estimated to have a useful life of 5 years and a residual value of $10,000. The asset has been depreciated for 2 years using straight line, right? So here's the cost minus the salvage value divided by a number of years. So you're at $26,000, and you've been doing this for 2 years. So what this looks like is I should really start this over further. You've got an asset. I forget what it was it machinery, equipment, but alright, so I'm just calling it an asset. You wouldn't normally call it an asset, you would call it by its right amount, right? But the asset was, sorry about that, the asset was worth $140,000, right? So let's put let's get rid of that. The asset was worth $140,000. I may not have enough room for $140,000. Okay, I do. And the accumulated depreciation was $26,000 for 2 years. So adding that up, we've got $26,000 in year 1 and $26,000 in year 2. So where we are right now is we've got $52,000 worth of accumulated depreciation and a $140,000 asset, which gives us, whoops, sorry about that, which gives us a net book value of 140 minus 52, which is $88,000. That's where we are right now. So if somebody asks, so this is the point that we're going to have a change. Let's get to the next slide. This is our net book value today, right? After 2 years of depreciation, it is worth $88,000 to us. Okay, back to the PowerPoint. So now what happens? What happens is, at the end of 2 years, the asset's book value is $88,000, which we just calculated. And during the 3rd year, the company estimates that the remaining useful life is 8 years instead of 3. So we thought we were going to only use this asset for another 3 years, when in reality we're going to use it for 8 years. And that the residual value is $8,000 instead of $10,000. Okay, well, we can deal with this. So let's move over back to the paint screen. What we do is we take the value today and use that as our cost in this calculation. So our numerator is going to be the $88,000, which is our book value today, minus the new residual value of $8,000, and that is going to be divided by the 8 years remaining. 8 years. And what that's going to calculate out to is now we're at $10,000 a year depreciation per year. So going forward, the full depreciation amount that we're going to use is $10,000 for the next 8 years. So let's see. Let's see if I can do this cleanly. Hang on a second. Okay, so if you had $10,000 for the next 8 years of depreciation, 10,000, 10,000, 10,000, 10,000, and I ran out of room, but we would go all the way down through the next couple of years there. And you added all of these guys up. Let's see if I can squeeze this in here. What you would have at the end of it is $132,000 of depreciation. Again, sorry about the squish in here. You'd have $132,000 worth of depreciation, which leaves you with a net book value of $8,000, which is the $140 minus the $132,000 of accumulated depreciation, leads you with the net book value of $8,000, which is exactly, or I'm sorry, which leaves you with the residual value of $8,000, which is exactly where you want to leave things off. Okay, so the key part here is realizing that you're going to take the value, if you change your estimates based on how long something's going to be good for, how long it's going to be useful, what the residual value is, or any of those kinds of, any of those changes, what you need to do is take the book value as of the day that you make that decision. You take the $88,000, which was the $140 minus $52,000, to come up with that amount. Okay. Okay, so now that we're done talking about depreciating assets, what happens when they're depreciated? What happens when we get rid of these assets? What happens when we fully depreciate them and they're done and gone? Okay, so let's say we have a piece of equipment and the piece of equipment was worth $25,000 and it's been fully depreciated. Okay, so it's worth $25,000, and when they say it's fully depreciated, that means there's nothing left. So let's say there's no residual value. Here we are. We've got equipment, accumulated depreciation, $25,000. Our net book value is 0. Maybe we're done with this equipment. It's time to throw it away. Goodbye. Get it off of our accounting records. Well, what we need to do is we need to zero out these accounts. In order to zero them, this is very similar to closing entries. What we're going to do is we are going to credit equipment, and we are going to debit accumulated depreciation. Alright, so what it looks like is this. Debit accumulated depreciation for $25,000 and credit equipment for $25,000. Because what we're doing basically is we're making these accounts to be 0. Now the value in here is 0. And the value in accumulated depreciation, its related contra account, is 0. Because if you're getting rid of the equipment, you better get rid of the accumulated depreciation that's tied to it as well. So that's how you take a fully depreciated asset off the books. And here's the journal entry. There you go. Okay, from our slides. Let's move on. Let's say, actually, you know what? I'll see you guys in the next set of these because this one's going to take a couple of minutes.